Okay, in this video, I'm going to talk a bit about inventories. Um, there are, broadly speaking, two inventory methods. Perpetual inventory. Perpetual inventory is when, at the time a sale is made, we're going to record the cost of goods sold. Then there's the periodic inventory method. And the periodic inventory method waits until the end of the period, counts what's on hand, and assume that the difference between beginning inventory and purchases minus what's on hand is going to give us then the cost of goods sold. But the question always is, well, how much should go to cost of goods sold? And when goods are acquired over time at different prices, then that becomes a valid question. How do we allocate the cost of a good to the cost of goods sold? All right, so there's different ways that we can do it. There are what we call cost flow assumptions. All right, specific identification. Used, for example, at an automobile dealership. Every automobile has a different VIN number. And so when one particular automobile is sold, then the cost of that automobile is going to be recorded as the cost of goods sold. But that's because there's two reasons. Number one, there are high ticket items, and we know the cost of each unit. Now, most of the time, there are going to be identical units. So if you go to the grocery store, every can of beans that's of a certain brand and type, they're all the same. When you go to the bookstore, they will have inventory of so-and-so's book, and each one of those would be what we call homogeneous. There are many different units in inventory, but there are homogeneous units in terms of any particular item in inventory. So when that happens, we can use one of three different methods, and this is for financial reporting purposes. We can use average cost. And the average cost says we're just going to figure out on average how much each unit costs, and then we'll multiply that average cost by the number of units that were sold. Then we have first in, first out. First in says the cost of the first units that were acquired, and those units are often in inventory, are going to be the first costs that go out to cost of goods sold. So the earliest costs are going to go into cost of goods sold. That means that ending inventory is going to be made up of the most recent costs. And then the last one that we have is the LIFO method, or last in, first out. LIFO means that the most recent unit acquired, or the cost, let me be specific, the cost of the most recent unit acquired is going to be the first cost that goes into cost of goods sold. All right, and then the ending inventory will be made up of the earliest costs. Now, we're going to do, first of all, perpetual, or I think that this video is going to last long enough for the perpetual inventory method. And here is our example. So Red Rock Company, for a particular item in inventory, at the beginning of the year, there were 40 units on hand, or 40 units in the inventory, and those units cost $4.50 each for a total of $180. All right, now during the period, they made several purchases. On the 2nd of January, they purchased 100 units at $5 each. On the 13th of January, they purchased an additional 50 units for $5.40 each, or $270 total. And then at the end of the month, they purchased another 50 units and paid $5.25 each, for a total of $262.50. So all of this, the beginning inventory plus the purchases during the month, the cost would tell us that 180 plus 500 plus 270 plus 262.50, that was the cost of what was available for sale. And that adds up to $1,212.50. This is what was available for sale in terms of how much those units cost. Now, the next part here is, well, how many units were available to sell during the month of January? And that would be the sum of the units, 40 plus 100 plus 50 plus 50, which gives us 240. So there were 240 units that were available for sale. Those 240 units costed a total of $1,212.50. Now, during the month, they tell us that on the 3rd of January, they sold 60 units. The selling price was $950 for a total sales of $570. Then on the 20th of January, they sold 75 units, and the selling price was $10. So they had revenues of $750 from the sale on the 20th of January. So when we add this up, 60 units sold and 75 units sold, we have a total of 135 units. So we know that we had available for sale 240 units. We sold 135. So that means that what was left was 105 units. All right, so here is, let me just sort of emphasize this one here. The ending inventory was 105 units. Okay, now the next question that we have is, well, how much did those units that we sold cost? How much did those units in ending inventory cost? And the amount of the cost of goods sold, that is the cost of the 135 units sold, will be computed using either specific identification, first in, first out, LIFO, or weighted average. And the same is going to happen for, we'll calculate the cost of the ending inventory a little bit different for each of those methods. So recall, let me just scroll back up here. Right now I'm looking at perpetual inventory. And perpetual inventory means that when we have a sale, so we debit cash or accounts receivable and we credit sales, then at the same time, we're going to record a debit to cost of goods sold, which is an expense, and a credit to inventory to show that the inventory, which is an asset, is now less. All right. So, for example, then on the 3rd of January, they sold 60 units. They're going to record revenues of $570. Now, what will be the cost that we record for these 60 units? And that just depends upon which method that we use. And so the first method that we are going to look at here is the FIFO method, first in, first out. FIFO, and let me just emphasize this is FIFO Perpetual. All right, so the cost of goods sold, remember, is the earliest cost. The ending inventory is going to be made up of the most recent cost, but considering perpetual. So let's start off here with computing the cost of goods sold. All right, now, let me, all right, I'm going to split the screen so that we are able to see. All right, so there were 60 units that were sold, and we're going to start off with the earliest inventory costs. So we have, whoops, I don't want that underlined. All right, so we have 40 units, and those 40 units cost $4.50 each. And though that gives us then $180. All right, that's what we have right here. Now, but we still got to get to 60 units, and we've only had 40 at the earliest cost. So now we're going to have to add 20 more units at the next price, which was $5. So 20 units, $5 is $100. So now we'll see here that we've got 60 units, which matches the number here, the sales. And those 60 units will have costed, the sum total here, 100 plus 180, which is $280. All right, so therefore, when we record the sale, $570, and the cost of goods sold is $280. All right, so what is the cost of the ending? Oh, wait, I'm not finished yet. Excuse me, let me go back here. So this was the cost. All right, so this, let me add this here. This was the cost of the 3 January sale, and then the cost of the, oops, all right, and then the cost of the next sale, which was the only other sale, which was on the 20th of January, and that would be, now take a note here that after we computed the cost of the January sale, though there were 100 units at $5. Well, we've already used 20 of those units, so there's really only 80 of them left at the $5 price. But that's not a problem for us at this point because we have 75 that we sold, and all 75 will come out of, let me see if I can, just a second. All right, so after the first sale, okay, I want to strike through, I'll do a double strike through. All right, so the 80 are gone. I mean, the 100 are, 20 of the 100 are gone, so we've got now 80 left. And they sold 75, so the cost of the 20 January sale is going to be 75 units at $5 each, and that will give us a total of $375. All right, so then the total January cost of goods sold is going to be equal to 280 plus 375, and that will give us a total of $655. Okay. All Now, let's go back here. Of this 80 units that we had, we're going to remove then 75. All right, so now I'm going to put a double strike through on that number. And what's left then is going to be only 5 units. So what is the cost of the ending inventory? Well, the cost of the ending inventory is the cost of what was not sold. And that would be 50 units that were at $5.25, 50 units at $5.40, and then these 5 remaining units at $5 each. So the cost of the ending inventory will be, and I'm going to start from the bottom and work backwards, 50 units at 5.25, and that would be $262.50. Let me just kind of bold this a little bit. All right, then we have, going back to the next purchase, another 50 units. All right, so now we have another 50 units, but those units were purchased at $5.40. So I'll have 5.40, and that will give us $270.
It's 0:30.
Okay, sorry. You can see I'm in the middle of the night trying to do this. And then the final thing that was not sold are these 5 units at $5 each. And 5 times 5 is 25. So now we're ready to then compute the totals. All right, so we have 50 and 50 and 5 is 105 units. And those 105 units will have costed the sum total of $262.50 and $270 and 25. So that brings us to $557.50. $557.50. And what we can do at this point here is to double check our work. And by double checking, what I mean is that the cost of goods sold plus the cost of the ending inventory needs to be equal to the cost of goods available for sale. So our check is going to be $655, which is the cost of goods sold, plus $557.50, and that will equal to $1,212.50. So this then is a good sign then that we have more than likely done our work correctly. Okay, I was trying to find a check mark, but apparently there is not one here. There we go. All right, so what is the gross profit using the FIFO method? And just to recall, gross profit is equal to sales minus the cost of goods sold. All right, so in our case here, sales were, let's see here. All right. Okay, So the sales are going to be 60 units at $950, and that would be $570. And then we have got 75 units at $10, and that was $750. So then our total is going to be 135 units that were sold, and the total selling price, 570 plus 750, is equal to $1,320. All right, then the last question that I'm going to cover is then what's the gross profit percent? You've done that, or you will be doing that for the SEC 10K, but the gross profit is going to be then, well, the gross profit. Well, you know what? I did not finish this one. Sorry, it's late at night and I'm kind of jumping over things. So the cost of goods sold was $655. So our sales were 1,320 minus 655. So therefore our gross profit in this case here is $665. All right, so it's slightly different there, but this is the gross profit number, $665. So then what's the gross profit percent? It's 665 divided by 1,320, and that gross profit percent is going to be 50.38%. So I'm going to encourage you as you do the SEC discussions, carry out to 2 decimal places, because that is a little bit richer in terms of understanding when we're trying to do comparisons across companies. All right, now let's prepare the journal entries to record the transactions of the 2nd and 3rd of January, assuming the FIFO method. So on the 2nd of January, they purchased 100 units at $5 each. So on the 2nd of January, we're going to record a purchase, and that was a debit to inventory for $500. And we're going to credit, I'm going to use accounts payable because that's generally how goods are purchased, but if they paid cash, then we would have credited cash. Now, on the 3rd of January, we're going to have 2 entries because on the 3rd of January, they sold 60 units, so we're going to record the sale. And then at the same time, we're going to record the cost of the sale. All right, so, and the cost, computed here, was $280. So on the 3rd of January, first entry is to record the sale, and we don't know, so it could be accounts receivable or it could be cash, $570, and then the credit will be to sales or to revenues. And then the second entry that we're going to record on the 3rd of January is going to be the cost of the sale. And recall that the cost was $280. So we're going to debit cost of goods sold, sometimes just COGS, and that was $280. And then we will credit inventory because now $280 of inventory is no longer on the shelf, it's been sold. All right, so that is FIFO FIFO perpetual. Now, let's go ahead and take a look then at the LIFO method. All right, so let's see here. All right, so last in, and this is LIFO Perpetual. Now, LIFO Perpetual means that every time we make a sale, the cost of goods sold is going to be based upon the most recent purchase costs. All right, so I've done this already for you, but let me just kind of go over. All right, so after the purchase or sale, what is the inventory on hand? Well, the beginning inventory was 40 units at $4.50. And so that would be the inventory on hand on January 1. Now, on January 2, they purchased 100 units at $5 each. So on hand, after they made the purchase, will be those original 40 units plus an additional 100 units that were just purchased. And so the sum total of that is $680 $80 of inventory on hand. Now, they sold 60 units on the 3rd of January. This is LIFO, last in, first out. So the last in were these 100 units. And remember, we're doing inventory, so we're doing inventory at cost, not at the selling price. So of this 100 units, well, they sold 60. So therefore, there's only 40 of them left. So let me just strike through that. And we know then that what's left is 40 units. And so therefore we have on hand, after selling 60, 40 units. This is the original 40 units in beginning inventory, and then another 40 units, which is what's left of the 100 that were purchased on the 2nd of January. So understand that this is the cost. It's not necessarily these exact 40 units and those exact 40 units. More than likely, from the physical flow, of course, it makes sense to sell the earlier units first. But the cost that will be assigned to the units is going to be based upon last in, first out. Now, on the 13th of January, they purchased 50 more units. So we've got these 40 and 40, or 80, plus now another 50 that were acquired at $5.40. So when you add up all those costs, the total cost of the inventory on hand after the 13th of January purchase is $650. 180 plus 200 plus 270. Now, on the 20th of January, they sold 75 units. So we're using LIFO. The cost that we will assign to that 75 units is going to be, first of all, these 50 units. They're all sold. They are not left, or at least that cost isn't left. All right, so let me eliminate. So I'll do a double strike through. And after the 20th of January sale, there are none left at the $5.40 price. But that's only 50. We've got to get to 75. So therefore, of this 40, we have to take away 25. So we have the total of 75. And that means then that of the 40, 25 were sold. And therefore, that will mean that 15 are left at the $5 price. So now we're down to here. What's left? Well, what's left is 40 units at $4.50, 15 units at $5. None of these for $5.40 units. So here is the total cost of the inventory on hand after the 20th of January sale. And then the 31st of January, we have these 50 units that were purchased at $5.25 each. So what's on hand at the end of the month? Well, the 40 units at $4.50. If I go back here, these are this cost is still on hand. 15 at $5, and then 50 at $5.25. So this gives us a total. So this is the ending inventory, right? At the end of the month. So now what we're going to do is I've computed the cost of the ending inventory already. So let me just mark here. I'm going to say see above. And the amount is $517.50. Now, what is the cost of the goods sold using LIFO Perpetual? All right. Now, so we're going to go, let me split the screen again. All right. So recall that those 60 units, we took them out of that 100 at $5 each. So we have 60 units at $5, and that will give us $300. Then, next of all, they sold 75 units. Well, the 50 of those 75 will be at the $5.40 price, or a total of $270. Then recall that we took another 25 from the 40 that were remaining from the 2 January sale. So we have 25 units, and they were at $5 each, and that gives us $125. So no too many zeros there. Okay. So, all right, we have 60 plus 110 plus 25, and that's 135 units sold. And the total selling price will be 300 plus 270. That's 570 plus 125, 670, 695. All right, so the cost of goods sold during the month using LIFO Perpetual will be $695. All right, so let's just do our check. All right, so double check. Remember, we said that the cost of goods sold plus the cost of the ending inventory is going to be equal to the cost of goods available for sale. All right, so cost of goods sold was $695. The cost of the ending inventory, remember we calculated it as $517.50. So when we add those two together, let's see how to do this. So I need my phone. All right, so this should be equal to $1,212.50. And again, this serves as a check. All right, remember we said the cost of goods sold we computed were $12.50, and that is then the amount that we have calculated. All right, so what is the amount of gross profit using the LIFO method? Well, just to kind of recall, I'm going to go back up here. when we were computing what was the sales, and the sales were $1,320. That doesn't really change. So we have $1,320 of sales. All right, and the cost of goods sold, LIFO, and let me just add in here, Perpetual. The cost of goods sold was $695. So therefore, then the gross profit is going to be equal the difference between these two. And that is $625. All right, so now let's take a look here. We're going to do two transactions. The first one is to record the transaction of the 13th of January. Well, what happened on the 13th of January? All right, and on the 13th of January, they purchased 50 units. All right, so 13th of January, we're going to debit inventory. Sometimes they will use the term merchandise inventory, but that's fine. That will be $270. And then we're going to credit accounts payable, or it could be cash, but we're going to assume, generally speaking, that it will be accounts payable, and that would be for $270. Then on the 20th of January, they sold 75 units. Now, let me just go back to my computations here. The 75 units that were sold are going to be these units here. So I want to just kind of highlight these two. All right, so again, 20th of January, they sold 75 units, right? Yes. So they would have accounts receivable, and that would be for $750. And then we have a credit to sales or revenues, $750. The second entry that we have to make is going to be the cost of the goods sold. So the 20th of January, we're going to have cost of goods sold, and it will be debited for $270 plus $125. That was the cost of those 75 units. So we're going to have a debit to cost of goods sold, for $395, and a credit to the inventory of $395. All right, I'm going to stop this video here. And since it's almost 1 o'clock in the morning, I will work on getting the other video done in the morning. Now, I will be traveling on Sunday, so I will try and get this done, the other part done in the morning before I go. All right, have a good rest of your studies of Accounting 220.